Today we are talking about hedged versus unhedged Canadian ETFs that trade on the Toronto Stock Exchange that give you exposure to the international markets. We'll talk about the pros and cons and which one might be the best for you, and some of the risks that we don't take into consideration as Canadians investing overseas in different currencies. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, I'd like to ask you a huge favor. If you learn something new or you get some value out of the video, smash that like button for me. It definitely helps me out. And if you haven't already, consider hitting that subscribe button, turning that notification bell on. I would definitely appreciate that. So let's start off by looking at this article by Money Sense, and it talks about the two types of risk. So the first type of risk is pretty evident. You buy a stock, it could go up or it could go down. That's with every different stock that you can buy. The second one is a little bit less obvious, and I feel like it's one that we as Canadians don't take into consideration if we're buying US stocks in particular. And that's the fact that you're exposed to a different currency. You're exposed to the US dollar. So if you hold US stocks and the greenback, which is the US dollar, rises in value relative to the loonie, you get a boost in return. So that'll actually give you a better return than what the stock is pulling back, like what the stock has gained. On the flip side, if the loonie rises and the US dollar falls as it has in recent months, then your returns will suffer. So that is where the hedged ETF comes into play. That means that the ETF will hedge the portfolio to the Canadian dollar to eliminate that currency risk. So the way that they do that is they use a strategy that employs instruments called currency forwards, which allow them to lock in a specific exchange rate at a future date. So they're going month by month to figure out where they see the exchange rate going, and they're buying futures contracts at that rate so that you can focus on just what the return of the stock or the equity or the ETF is going to do. You eliminate that currency risk out of the picture. And that's with a hedged ETF. So just to give you a little bit of a further example, during any period when the Canadian dollar is rising in value, much like it is today, whether against the US dollar or some other foreign currency, could be the pound or the euro, using ETFs with currency hedging will lead to higher returns in your foreign equity investments. So hypothetically, if you were over the past couple months holding a Canadian dollar hedged ETF, you would have performed really well because the Canadian dollar is appreciating. It's doing better against the US dollar than it has in the past, so it's kind of added on to your returns. And on the flip side, whenever the Canadian dollar loses value relative to foreign currencies, the unhedged versions will win out. Well, that kind of makes it simple right off the hop, right? It kind of makes you think, okay, so I'm going to go into my portfolio, and when the Canadian dollar is rising, I'll buy the hedged one. And when the Canadian dollar is falling, I'll go in, I'll switch it to the unhedged one. Well, if you're a passive investor and you don't have time for that, and we've talked about it before, it's very difficult to time the markets. It's better to be time in the markets, then realistically it's better to just pick one. And which one works for you? Well, let's figure that out. So the hedging isn't always precise, is one of the cons when it comes to owning the hedge side of things. As we've explained, funds hedge currency using currency forwards. Typically updated these contracts once a month, which means that they can't track daily fluctuations. If it moves very swift, very fast, this hedge ETF will not be able to track it. So that is definitely a con for using that. When it comes to using unhedged portfolios, they are less volatile. It's misleading to say hedging strategies eliminate currency risk, because this implies that non-hedge ETFs are more risky. In fact, there's evidence that adding currency diversification actually lowers the volatility of a portfolio, at least for Canadian investors. That's because the US dollar has some negative correlation with the global stock market. So when the stock market does fall, the US dollar is considered a safe haven and it drives up the value. So taking a step back and you're saying, okay, well, that's very interesting information. I get the fact that I'm a passive investor. I don't want to time the market. I want to pick one right off the hop. What's your suggestion? Well, based on this article here, if we were to take a look at one of the bigger pension plans in the world, the Canadian pension plan, CPP, if you're Canadian, everybody contributes to it. They hold billions of dollars in foreign assets and they do not use currency hedging. While currency exchange rate fluctuations may have a significant impact on our results in any given quarter or year, the CPP Investment Board writes in a recent report, we do not expect them to have a significant impact on the fund's long-term performance. Okay. So what are you telling me here? You're telling me to go with the unhedged? Well, the best way to do it is to take a look at two funds, one a hedged and one an unhedged, and we can do this through the iShares ETF product that trades on the Toronto Stock Exchange. The hedged version is XSP. We've had it compared here to the unhedged portion, and that ticker is XUS.TO. And right now we're taking a look at the 5-year performance of both of them. The purple line is the unhedged one, the blue line is the hedged one, and the percentage difference is very minuscule over a 3-year period of being only a 3% difference. Now, 3% may be a lot in the grand scheme of things, but for you to go in and time, was here the right time to switch, or was here the right time to switch, you wouldn't really be able to do that. So it does become a little bit more difficult, but we can really see the impact of if you are an active investor and making and knowing when to make that switch, which is very difficult to do. But the Canadian hedge one has performed, and this is in direct correlation to the fact that the Canadian dollar has appreciated vastly over the past year, and it could make in the short run up to a 20% difference, but again, over a longer period of time, and that's the time duration that we want to be holding these, especially for younger. Buy and hold these and put a certain allocation, a certain dollar amount in per month. And again, 5-year difference between the two funds is only 3%. So yes, in the short run, it could look like one is better than the other, but realistically, we want to be holding these things for 10, 20 years. So we're taking out that time risk. And it looks like the unhedged one is probably the beneficial one, especially if the Canadian dollar is where it's at right now. And with the Canadian dollar being where it's at right now, it's on the upper end of the band, and it could definitely swing the other way. And if the CPP doesn't use a hedge version, then maybe we might be looking at just going into the unhedged version. That one might be the best. There's another article here which talks about reasons not to hedge. So first reason is that the US dollar often has a parachute effect during major crisis. We've talked about this very briefly in the other article, is that the US dollar is a safe haven. So if the market does crash, it is considered to be, it will appreciate, it will do better if the market crashes. So it's a protection, it's a hedge in the portfolio. The second reason is if you will need US dollars in the future. So you don't want to buy something that's hedged If you want to move to the US in 10, 20 years, if that's the game plan, then there's no sense in hedging, because when you sell these, you don't want to convert back to Canadian. You'll want to hold these directly in US dollars. And currency risk hedging is expensive, is the third one on the list. Basically what it's saying here is that if you're by opting for an ETF or mutual fund that is hedged against fluctuations in the US dollar, you delegate this task to the fund manager. Basically, the fact that the currency forwards will be in the hands of the manager, and we all know that the market could swing in either way, and the crystal ball factor doesn't really give you a true depiction of what's going to happen. But let's take it all back. Let's take it into consideration. It seems as if there is no real difference. It looks like over a longer period of time, the percentage difference is so minuscule. But if you are an active investor, there is ways to take advantage by looking at where those two currencies are at. And you can switch back and forth between the hedge and the unhedged. But if you're somebody who's passive and just wants to let that investment ride over a longer period of time, there is no difference whatsoever. If you're asking me right now what I would choose the unhedged one, because the Canadian dollar is at the upper end of that bound. And it might continue to go higher, but if I'm holding this for 10, 20 years, I would expect the US dollar to appreciate, the US dollar to get stronger. So again, I hope you learned something new in this video, in the sense that you can invest in foreign equities, in the foreign markets, in the Toronto Stock Exchange. You can choose ones that are currency hedged. You can choose ones that are not hedged. We all know that the CPP chooses the unhedged ones. We can play it if we're an active investor, depending on where that currency exchange is at the moment. And right now, again, if you were to ask me, unhedged is the way to go. If you learned something new, if you got some value, don't forget, hit that like button. It would definitely help me out. It would help out the channel. And if you haven't already, consider hitting that subscribe button, turning that notification bell on. I appreciate your support. Have a great week on the markets.